Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, we are looking at two amazing companies. These are companies that are currently down. They have a pricing power. That means when inflation is high, they can actually charge more for their products and services. For that reason, they can counter when it comes to inflation. They're great companies, they're growth companies, they have an amazing balance sheet. And we're going to check them out today to see if it's a buy right now or not. Before we get to that, I would like you to give this video a like. Any of the videos that you watch a like, I would really appreciate that because it definitely helps the channel. That's all I ask. If you can give it a like, subscribe to the channel, or click that notification bell thing, and let me know if you have any questions. It really does help the channel. So let's get started to being on the video and look at these two amazing companies that we're talking about today. Right, so the first one is Microsoft. Microsoft is a company that I own in my portfolio. It's one of those companies that are down so much right now. A year to date is 24%, okay, almost 24%. Last 6 months about 24%, and it's down 11% just this month. And just the last 5 days is down about 7%. So it's a lot. It's down quite a bit. This is by far one of the greatest companies out there, in my opinion. I love technology. I love Microsoft and everything they do. And so I might seem a little bit bullish when it comes to this, but they are really a great company. They have some amazing products. Okay, so let's have a look at their overall. I'm sure you know what they do. So they have servers. Basically, they do a lot of the Windows products. Theirs. They've got LinkedIn. They've got the basically the cloud-based software that they own, anything to do with Office, all of those things, Xbox and all of that stuff. And now they recently bought Activision Blizzard. They're on the process of buying them. They obviously, a lot of their products are basically being used in advertising and used in services, laptops, tablets and desktops, you name it. Basically they have done it all. Okay, currently trading $255 per share, EPS almost 10, $1.87 trillion company, wide mode and exemplary capital allocation. Right now is below 1, which is very nice in terms of beta. PE is quite high in my opinion, 26. I would love it to come down a little bit more. We'll see how it goes, because if the sector, that's not right. The sector is about 25, I think. I think that I need to update that one. I think it's about 25 right now. Price to free cash flow about 30. Dividend yield just below 1. 9% 5-year growth rate. 15%. 15 years of paying, basically increasing that dividend. Payout ratio only 26. Safety wise 99%. That's the highest any company can get from simply save dividend. Free cash flow 63, almost $64 billion. Think about that, $64 billion in the bank, just sitting there. I hope they do something with it, because otherwise inflation will eat away. Profit margin 37, operating margin 42, return on equity 50% almost. Revenue year on year 20% growth. Total return since for the last 10 years almost to 24.4%. Current ratio of above 1, which is very good, is almost 2. And the next 5 years, every single year of the next 5 years, analysts in Yahoo Finance are expecting this to grow about 16.2%. Simply Wall Street actually says is a buy, and well, as they say, is 40% discounted at the moment. Fair value $435 per share. 435. Right now we're looking about 255. Okay. Morningstar 26% discounted at the moment. 352 is the price they're looking for. Tip rank is more or less the same. These two almost agree, and it's a strong buy. In my opinion, it's strong buy. If you don't own it, if you do own it, okay. If you do own it, in fact, just give me 1 second. I'll show. I think it's my target is like 150 or something, 150, 140 or something like that. But I do own it. I'm up a little bit, and for that reason, if I buy more right now, I'm gonna average it up. And since there's so many other companies out there that are discounted at the moment that I'm down on, so those are the ones that I'm adding more money to it. But if it keep going down, I'm definitely adding more to this company, because I need to round it up maybe 20 to 25 shares. Okay. And as you can see here, I own 17.1 shares. My average is 220. In fact, my 220 is what I'm looking for. Okay, so based on what we've seen so far, so at some point this year to date, this stock was $330 per share. Right now we're looking at this, so I wouldn't be surprised if it goes down another 5 to 10% in the next couple of months. And if it does, then that's my chance to actually add more of this company. So that's the first company that we're looking at. Great company. The next one is equally amazing, and I own it in my portfolio as well. And this is Salesforce. Salesforce sells faster and smarter with the world is number one. So they have, in terms of sales, they have loads of different products, some which are used for sales, some which are used for services, marketing, commercial, engagement, platform, integration, analysis, analyticals, industrials, communities, enablement, collaborations. All of these fancy words, basically, they actually do it, okay? Whether it's through the platform, their own platforms, similar to Microsoft. So they have their cloud services, they have a software as a service. They are software as a service company. So this is what I love about this company. That revenue is just that comes in every single month. And it's one of those companies, once you're using their sales, you're also using their marketing, you're using their services, you're using for the commercial side of it. And then they analyze your data. They whatever you're doing, they do allow you to, like companies like Slack, for example, they bought recently. In terms of collaboration, you can work with your teams and so on. Once you've done all of that, it's very difficult to change. And this is one of the companies and one of the reasons why I absolutely love the Microsoft and Salesforce, because once you're in their environment, once you bought like a Microsoft server, for example, you're not going anywhere. You're stuck with it, okay? Because it's difficult to change and migrate completely to a different platform. Same goes for Salesforce. And because of that stickability, because of that product, the products they create, they can easily increase their price. So if they increase the sales bit, these companies have no basically legs to stand. They just have to accept that, okay? And for that reason, I will say is a hedge against inflation. And that's one of the reasons I actually love these companies, okay? And when you look at their earnings, for example, they're not just focusing on one side of the world, okay? They're everywhere, okay? And it's growing, okay? Every single, basically, area on their business is growing, and around the world is growing, okay? So it's really, really one of those, probably you can tell the way I'm talking about it, I'm very bullish on this company. And one of the things that I've noticed recently is actually being given wide economic mode, which is very, very good. And here Morningstar says, okay, after introducing the software as a service model to the world, Salesforce.com has blended a front office empire that can build on for years to come, basically. Okay, I don't think nothing is going to stop this company becoming the next Microsoft. And I said this so many times, okay? So let's have a look at the financials. In terms of the current price, it's $160 per share, EPS 1.848, $156 billion. Economic mode is wide, it's standard when it comes to capital allocation. Beta slightly above 1, PE just about 100, free cash flow about 30. They don't pay any dividend, but they do have a free cash flow of $5.28 billion. Profitability, this is where it gets a little bit tricky, and I think this is why it's still in their early days, I believe. And then maybe next 5 to 10 years, I'm betting on the fact that this company will start doing what Microsoft is doing, okay, in terms of this type of thing. So the profit margins, the operating margins, the return on equity, the revenue growth should still be good enough anyway, okay, and it is 25%. But these side of things, I think they will start picking that up in the next few years. But once they start investing, basically, they are right now in the still investing stage, obviously. But once they establish it very well and all that side of things, the revenue are growing, everything else, then that will pick up definitely. Total returns over the last 10 years, you're looking at about 17%. Current ratio just above 1, which is fine. Next 5 years, 15% growth. Simply Wall Street says about almost 40% discounted, so that should be green. Again, 50% according to Morningstar. Okay, $320, that's what they're expecting, but according to TipRank, it actually says 86%, which is very different. That's very strange. Let me double check that. Yeah, it's correct. So they're expecting $294 per share, and they expect this to be 83.52 upside, and it's a strong buy. According to 25 of the analysts out of the 28 have said it's actually a buy, and 3 said is hold. So when you look at these analysts, they're all from different companies and different banks and whatever. Okay, but there's so many people looking at this. Again, this sometimes I don't like companies that have had so many analysts, but it's a good thing, to know, right? So if this guy is saying it's about 300, so that's 100%, over 100%. Okay, 40%. Even though this person is saying it's a hold, okay, it's 40% upside. This one 87%, 100 and whatever. Okay, even the one that is saying is a hold is a Citigroup, for example. They're saying it's a hold, but it's $233 per share. That gives you about 50% upside right now. So this is why I'm bullish on this company, and this is one of the reasons I absolutely love. They have a great balance sheet, okay, in my opinion, and they are in the right industry, which I actually love. And I own this company in my portfolio, so let me show you that. Right, as you can see here, I own 15 shares. So what I've done is I've sold out the one I had on Freetrade, because that one I bought it when it was really cheap, so I basically was in the green. So I sold that one out and included, I basically took that money and put it here. So as you can see right now, everything is in one place. I've got 15 shares in my ISA account right now. Okay, average of $203. So by actually selling that one and buying more of this, I averaged down, which is actually quite nice. And my price target for this company, if it comes down to 150, I will also be adding more to it. Right now it's 160, so I'm thinking maybe the next couple of weeks it might actually come down, and if it does, I want to buy more. I want to round it up to maybe about 20 shares and completely and utterly forget about it, okay, and let this company grow. And yes, it's down quite a bit at the moment. Okay, so you can see almost 15% or £350 down. Again, that doesn't worry me, because I'm thinking long term this company will be around and will be absolutely great investment. Okay, so that's my take on these two great companies, Microsoft and Salesforce. Again, if you're interested in any of this business, please do me a favor, just do your research. Like I've always said, I'm not a financial advisor. I'm sharing my journey with you guys. I'm sharing some of the things that are happening in the markets, because I've realized in the last few weeks, okay, there's so many great companies that are down, like Microsoft and Salesforce and other companies that we've talked about in the last couple of hours, days. Okay, so it's really important to look in these companies and look at the fundamentals and see, has anything changed about Salesforce in the last basically whatever months, okay, to make like it's down 50%. But what has changed? Not really, not a lot. Okay, what has changed is the investment, basically the investor has changed. We've changed. We've now in our head, like we worried everything is going to go to zero. And company like this is 5-star right now. That's the cheapest it can get. Look, right? To get to 5-star was supposed to be $220 per share. Right now, the last close, right? And they expected the price, the highest, okay, when it gets to 1-star, when it becomes really expensive, it will be $431 per share. And right now it's $224 per share. That's where they think the 5-star should be. But right now we are $160 per share. So $160 per share, and possibly after the market opens today, it'll probably go down another 5%. So anyway, that's my take on those two great companies. I hope you're enjoying the videos. If you are, please like, subscribe to the channel. Have a wonderful day. Assalamu Alaikum.